And welcome to Inside India. I'm JP Ong. Here are your headlines. The Fed cuts rates expected by 25 basis points for the first time this year and left the door open for more easing as concerns about the labor market outweighed inflation risks.
While the unemployment rate remains low, it has edged up. Job gains have slowed and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated.
The European Union looks to forge closer ties with India as the two sides aim to conclude a trade deal by the end of the year. Meanwhile, India continues to foster trade relations in the Gulf. Commerce Minister Piyush Goyal in the UAE today, where he will be meeting with Indian and Emirati business leaders. Hey, good morning and welcome to the show. We are going to start off once again by looking at how Asian markets are shaping up, and it seems like it's all systems go for most major equity indices across the Asia Pacific. This after the Federal Reserve decided to cut rates for the first time this year. That 25 basis point trim enough to give the Nikkei 225 room to rise and once again test new record highs out in Tokyo a day before the Bank of Japan makes its own policy decision. And the TAIEX in Taipei also up by about 0.7%. Interestingly enough, we're seeing a bit of a mixed reaction across Chinese markets, with the Hang Seng about 0.1% in the red. This after China decided, or the PBOC decided to leave the 7-day reverse repo rate unchanged despite the trim from the Federal Reserve. Australian stocks also languishing, being pulled down by lower energy and mining stocks down under. The Federal Reserve is lowering interest rates for the first time since December and signaled more easing for this year. The 25 basis point cut putting the Fed's fund rate in a range between 4 to 4.25%. Newly installed governor and Trump ally Stephen Miron was the only policymaker who voted for a jumbo half-point cut. But Fed Chair Jay Powell is saying there's no need for an aggressive move right now.
There wasn't widespread support at all for a 50 basis point cut today. You know, I think we've done very large rate hikes and very large rate cuts in the last 5 years. And you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to the much lower level of job creation and other evidence of softening in the labor market and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now. And so that warrants a change in policy.
Well, here's CNBC's Steve Leisman with more details on the Fed's outlook for the rest of the year.
The Federal Reserve gave the market exactly what it wanted, a 25 basis point rate cut and a forecast for 2 more. But it also introduced some risk into the outlook. There was an expected dovish dissent for a 50 basis point cut by new Fed Governor Stephen Miron, but also widespread disagreement on the committee over the right path for rates.
Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you've got to be careful about inflation. So we have a situation where we have two-sided risk. And that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all surprising to me that you have a range of views.
You could see the disagreement on the committee in their forecast for rates this year. One official didn't want to cut at all. 6 want no more cuts after the one this time. 2 want 1 more cut. 9 want 2 more cuts. And 1, apparently Stephen Miron, the new Fed governor appointed by President Trump, wants 5 more cuts this year. That forecast, called outrageous by bond investor Jeffrey Gundlach, could be a sign of things to come. Joe Busuelos of RSM saying, quote, given the coming changes to Federal Reserve personnel next year, we urge all to take this forecast with more than a grain of salt and would strongly suggest that the Federal Reserve is moving in a direction where it will tolerate inflation well above target. Futures markets traded with confidence there will be at least 2 additional cuts this year, maybe even more confidence than Powell expressed. The key to the immediate outlook may be in the statement, which said that downside risks for employment have increased. As long as that's the case, the Fed may be cutting rates until the inflation and employment risks are balanced. Steve Leisman, CNBC Business News.
And the Indian markets are set to come online in about 40 minutes. And let's bring in the GIFT Nifty futures. Drum roll, please. And we're seeing that is indicating yet another day of gains, which will make it 3 straight days in the green if it does open the way it's foreshadowing. 25,519 points, about almost 200 points above the close when the Nifty 50 breached 25,300 at the Wednesday end. We are seeing that the Indian rupee is continuing to weaken now, 87.86 now against the US dollar. Now, Feroz Aziz is the Deputy CEO at Anand Rathi Wealth, and he's here to help us also understand or share with us his insights on the Fed's decision, what that will mean for Indian markets and the broader macroeconomy. Feroz, thanks so much for joining us. So let's start off with the FOMC decision. Again, many were expecting that there would be a rate cut then, and there are now perhaps signs of growing confidence that we'll see even more rate cuts until the end of the year. Is this pretty much all systems go for the Fed and easier monetary policy for global markets?
Good morning, JP. Nice to talk with you and your viewers. Yes, so if you look at how 2025 has had no rate cuts, this November was the last one we got, November 24. I think more rate cuts could be expected because it's on the back of a slowing labor market, slowing consumption. So I think this time there was a need for a rate cut, and that's where 25 bips comes. And there is a divergent view, like you just put it on the screen. But having said which, I personally think the markets, Indian markets especially, if you look at the last 8-10 of these FOMC meetings and the resultant outcomes, you would be surprised that when there was a 50 bips rate cut, we had almost about a market going down about 0.5% on that day. So basically, the Indian markets are not being too governed by the global indices and indicators. That's what I mean. But why is that happening? Because FIIs, who are the discretionary FIIs, who do active buying and selling in India, have liquidated their positions significantly. But the passive FIIs who pump in money on the basis of indices, the vanguards of the world, have been pumping in money and they're not managing their own discretionary money. So the impact or the volatility infused by these rate cuts in the Indian markets has been largely negatively correlated over the last 8-10, as you can see on the screen.
Yeah, and as you pointed out, perhaps the volatility has been pretty much limited or perhaps even contained with regards to Indian markets. But Feroz, I do want to talk about one source of uncertainty, and that's what people are making of with regards to the seeming dissent among the FOMC members, and also growing questions about the Fed's independence because of the appointment of Stephen Miron, which then also undermines perhaps credibility. But really, Feroz, when you think about it, can you really say that the Fed or any central bank is completely independent? Because many of their appointees are actually appointed by the leader of that country or state, as Donald Trump has appointed Stephen Miron and as he appointed Jerome Powell a couple of years back, actually. What are your thoughts on that? Is any central bank really that independent?
I think no, and shouldn't be either. See what happens. That's a very contrarian opinion. To my mind, I think, a central bank has a narrower mandate. The governments have a larger mandate. It's like a subsidiary company and a group company chairman. So there is going to be an internal debate when it comes to a chairman who has about 10 businesses to handle. There's one CEO who's handling one subsidiary of that holding company. So I would say that the debate is going to be very healthy. So to answer your question, they're not independent. Should they be completely independent? The answer is no, because central banks have a narrower mandate. Governments have a very wider mandate. That debate actually, in my opinion, is very healthy. Point one. Point two, if you look at how the Fed paper, 10-year paper of the US government has operated. We are at 4.01 today. The average for the last 3 years is 4.09. Finally, we slipped below the average on which a 10-year US paper has quoted. The 5-year average is about 3.4. The 10-year average of the 10-year US government paper is 2.63. So I think we are on the high end of the curve. In 2020, the 10-year paper was 0.5. The kind of volatility the debt markets show in the US is significantly greater than what Indian markets on the equity side show. A 10-year paper starting with 0.5% yield in a 5-year time zone, going to 4.99, that's a huge volatility. And a government which has got so much to borrow and refinance would be concerned about this, and that's where the push comes from.
All right, Feroz, with this decision, how is this influencing your outlook on where the U.S. dollar is heading, and in consequence, also how that might influence where the rupee will also move?
Yes, I think dollar index should further strengthen. That's my opinion. From an India and INR perspective, I think I would expect a rupee depreciation of almost about 2.5–3% for the next 3 years compounded, which means a 10% depreciation, which is what interest rate parity theory suggests. The interest rate differentials on the 10-year paper today are about 2.5% on INR and the US government paper. So point I'm trying to get to is a depreciation of 2.5–3% of the rupee is what finance tells it will happen. And if that was the case, I would be very happy. And that's what has been the case for the last 15 years. If you do like a 5-year rolling, the rupee depreciation has almost been equal to 1 sigma different than the differential between the interest rates in that period. So that's what I would expect, a 10% depreciation in 3 years and about 3% depreciation in a year.
All right, and how does this might this actually influence the RBI, or the Reserve Bank of India's own moves? Some say that there's a lot of scope to actually cut, but with growth actually strong, do they even need to move at this point?
I doubt. I don't think RBI needs to cut rates. We had a very flattish yield curve, which was a very scary thing for India. India has always had an upward sloping yield curve, which means a 1-year paper and a 10-year paper had a differential of almost about 150 basis points. That has almost become flat. And that's why the Indian banking system was not getting deposit growth. Because an Indian retail or an Indian HNI who deposits money in a bank wants a higher interest rate for a 5-year fixed deposit. So I think already the yield curve has become upward sloping again. I don't see a large case for RBI to reduce rates significantly. 25 bips here or there is not something which I would say is significant.
Okay, and so basically, if the RBI doesn't cut rates, I mean, does that also mean that the rupee might have time to stabilize itself if that differential starts to compress? You still think that the rupee has room to weaken, Feroz? Just quickly, why?
I would say weaken only from a perspective of interest rate parity. So short term, it may not weaken. When we handle HNIs and ultra HNIs, we have to take decisions which are more 6 months to a year, at least when it comes to currency, because there are a lot of NRIs who transmit money from the US. So I would expect some degree of depreciation by the end of the financial year.
All right, Feroz Aziz from Anand Rathi Wealth. Do stay with us. We're going to take a quick break, but I do want to get more of your thoughts with regards to the domestic markets in India. Stay with us as well, all viewers. We will be back in about 2 minutes with Inside India. And welcome back. Indian market regulator SEBI will work with the government to let banks and pension funds trade commodities. Chairman Tuhin Kantapandi saying the regulator is also weighing foreign investor access to some non-agricultural derivatives. SEBI says more institutional players will boost liquidity in these commodity markets. Shares of multi-commodity exchange reacted positively to the news in yesterday's session. Meantime, a stellar debut for shares of Urban Company. Shares surged as much as 74% in the first session and ended the day 62% higher, valuing the home services platform about $3 billion. It was one of India's most heavily subscribed IPOs this year, with bids worth $13 billion and more than 100 times the shares on offer. The listing comes as India's IPO market gains momentum, with record fundraising expected this year. And we are back with Feroz Aziz, the Deputy CEO at Anand Rathi Wealth. And Feroz, let's start off with the SEBI's own reforms and regulations. It seems that they're doing a lot to actually try and at least liberalize or perhaps even and perhaps loosen the guardrails around the markets, actually, from the likes of loosening load caps on mutual funds and reclassifying REITs. What does this mean for the broader market and capital structures, and how are you folks at Anand Rathi viewing these many changes that they've been introducing over the last couple of weeks?
Yes, the last few changes, if you just read them in context of the last 10 different changes which SEBI has done, one thing it is clearly doing is to bring in more liquidity, price discovery, both using the cash market and the derivative market. Lesser manipulation is possible if there's more liquidity, so that's what it's doing. The second thing it's trying to do is to curtail volatility. It's promoting long gamma positions of derivative traders. Third, it had from 2020 there was a short limit in the derivative segment. The derivative segment had a 5 billion rupees short limit. You can't unlimited short the index futures or index options, but that also now have a long limit, so that people are not going extra long suddenly to create huge changes in the derivative prices and the cash market prices and capitalize on the correlation. From a domestic standpoint, mutual funds, they've brought in immense clarity. They've tried to narrow the universe. We are the largest number of listed stocks in the world, India. So, but it could have a lot of illiquid stocks. So SEBI has curtailed the mutual fund participation largely to the top 500 stocks, which are liquid counters, to create more governance, more transparency, more clarity in the buyer of the mutual fund. And that's why you see almost 50 trillion rupees is expected to come in from the domestic institutions over the next 8 years into the Indian capital markets.
Yeah. One other thing they've also done is try to loosen the regulations around the IPO pipeline to help boost listings. But as you saw from Urban Company's debut yesterday, does India really need any more help with regards to liberalizing or loosening the IPO pipeline that seems to be gushing relative to other markets in the world?
There's a desperate need, and I would say that on a scale of 10, we need it as much as 11. Why? Because India has a lot of domestic participation possible. There are fewer companies, ironically or sadly or happily, I don't know, but we are a listed company for just about 4 years, and we've become the 270th free float market cap in India, and we are just a $3 billion total float and about $1.5 billion free float. So there is very little free float available. In India, there are 90% of NSE 500 companies don't have the free float. Only 6% of them have more than 90% free float. But if you just go to the US, S&P 500 has 90% of the stocks greater than 90% free float. So a lot of free float is gobbled up by the promoter in India. Unless you put that free float and bring in new paper, you will see bubbles and valuation concerns. And that's what FPIs and FIIs have been very concerned. So I think we are very happy that promoters should bring down their stake. New paper should come so that price discovery is not because of lack of supply, but business dynamics.
All right. First, you were mentioning a while ago before we came back from the break that the other move to note also is that there is a move to tighten equity derivatives at the moment, or access to equity derivatives, to help at least safeguard some of the investors. Can you elaborate as to why this was an important move from SEBI?
It was an important move because India is a very large country. The Indian retail does not understand the technicals of derivatives, which is a Black-Scholes pricing model. They've not even heard the name. If someone has won a Nobel Prize in pricing derivatives, the institutions have a very large edge, or a learned derivative trader has a very large edge over the 99.5% who are just using it for a speculative purpose, which is called the delta of the option. There are several Greeks of an option: delta, gamma, vega, theta, rho. The four other Greeks are being traded by high frequency traders, institutions, or very well educated derivative traders. On the other hand, 99.5% of the people are not even, they're only trying to use the derivative instrument to speculate on the direction of the market, which is called the delta. So this caused a lot of pain and loss to retail investors, and retail investors needed some curbing. So the weekly options, there was actually just about 6-8 months back, on every day of the week, there was an index which was having an expiry, Monday, Tuesday, through to Friday. So many people had left their jobs and were just doing derivative trading on a everyday basis. So that required a huge change. What they did was they curtailed the number of weekly expiries to two now, not all the 5 days. Second, they did was to increase the margin money needed on the expiry days. They almost doubled it, so the volumes dropped on a one-day expiry. Now they're trying to promote long-term derivatives, which are called LEAPs, long-dated equity anticipation securities. So they're doing a variety of things in the direction of protecting the retail investor who's wanting to speculate, and that's not a good idea for any Indian regulator to promote. So that's what they're trying to do. And I think 3 more changes are expected over the next 6 months.
Oh, and it seems that the table is being set for a better and more well-regulated market in India. But first, I want to get your thoughts on this. It seems that you have these rate cuts from the Fed, a weakening dollar, which has seemed to boost emerging markets like India. But if one might argue that year to date, the equity market, or the Nifty at least, if the Nifty can be that benchmark, hasn't done as well as it has in previous years. And we've also heard that foreign funds are continuing to be a little bit cautious actually in India. Why do you think there's been a little bit of that, a cooler appetites towards the Indian equities as compared to a couple of years ago, despite all of these possible tailwinds for the stock market there?
JP, if you look at last year, September, we were at the peak. We are now taken a 1-year time correction. You're so right. Last September, we are higher than where we are today. We've seen a price correction of 5-6%. This is happening because FIIs have sold almost 1.4 trillion rupees. DIIs at the same time have bought 5.5 trillion rupees. Just before the September of 2024, we had a huge rally. So where we had outperformed the global peers, now we underperformed the global peers. Earnings of Nifty have gone up 11% over the last year. So that's a great news. So coming to your point of why have we seen such an abysmal rally over the last 1 year, I think the previous 1 year, previous to 24, were very good. And liquidity has been a challenge from the FII side. Derivative markets have gone through some challenges. The trade war has created some panic. But if you look at how the markets have rebounded from 21,700. Nifty touched 21,700 twice this year. Trump also gave us a lot of bad news, 50% tariffs and stuff, but still the markets have been very resilient. That you would notice, they've operated in a very small range for the last 3 months in spite of a lot of global headwind. That's because of domestic monies are almost about, last 2 months, we had more than 1.3 trillion rupees added by the domestic institutions, and that is not going anywhere. And that's the key message. So we will be traced back the peak in Nifty. I would not be surprised if the odds are more than 95% that we will establish a larger value than we have ever seen on Nifty in this financial year with the 95% odds.
Yeah, and these tailwinds and these upsides, I mean, you add the GST reforms also, it seems that there is going to be a case for, a bull case that is, again, for Indian stocks. First, before you go, are there any particular sectors you're looking at when you're trying to at least enrich the portfolios of many of your wealth clients at Anand Rathi?
There is a theme which I'm very bullish on, of course, consumption. So A, B, C, D, E is a good abbreviation to tell you what I'm looking at. A is for auto, banking. consumption, D is for drugs, and E is for energy, which is renewable energy. These are the sectors. ABC is what I've been bullish for the last 6-8 months, and that's paid off reasonably well. I'm adding D and E now. So these are the 5 sectors, or that makes it a theme based on consumption and domestic financialization. ABCD is what I would say is the theme, which can create an alpha about 3-4% on Nifty.
And do you think that one argument also, Feroz, was that the transmission of growth to earnings in India is a bit faster than, say, other markets like, say, China? Do you agree with that outlook? That earnings transmission and upside is faster when it is faster than, say, other major markets in the region?
Yeah, I completely agree that happens because of the lower base. And we have had, if you look at the mid cap and the small cap segment, that hypothesis is very, very true, may not be as true for the large cap space.
All right. Just quickly, Feroz, I do want to ask you about the rupee's weakness, and going back to that as well. Is that going to be a headwind at some point for, say, earnings or the markets? Because while it might be seen as a boon for emerging markets, will there get up to a point where it actually becomes a bit of a bane for the markets? Just very quickly, if you can, in like a minute, sir.
I think RBI has been very, very good in controlling it in a tighter range. And RBI also appreciates the depreciation to the extent of the interest rate differential. I don't think that's going to be a big problem because of the reserves we are currently sitting on.
All right. A lot of insights there and a lot of things to help us guide investors as they try to navigate and better understand the Indian markets. And who better than Feroz Aziz from Anand Rathi Wealth to share with us his insights. Thank you so much again and appreciate the time, sir. Well, coming up, India is speeding up trade engagements with the country's trade minister in the United Arab Emirates. We'll be back with more details on this after a short break. Please don't go away. Welcome back to Inside India. It is central bank bonanza this week. And let's start off first, though, with a check on how gold is trading. And the precious metal, as you can see here, finding room to firm up right now at $3,662 per troy ounce. And again, this also highlighting that gold seems to be holding on to some of its luster, actually, despite the prospect of lower or looser monetary policy and the prospect of risk-on sentiment maybe coming back on. A lot of this also with the dollar index in focus, and the dollar index now trying to find a firmer ground after it did trade lower, softer intraday hours after the Federal Reserve decided to make that decision to cut interest rates for the first time in 2025. The Hong Kong Monetary Authority is also moving in lockstep with the Fed, setting its base rate at 4.5%, which is about 50 basis points above the lower end of the Fed's policy rate range. The Hong Kong dollar right now, and we're looking at that currency just firmer, actually, at about $7.77 against the greenback. Meantime, we're also waiting for the Bank of England's policy decision as well. Pound sterling, and you can see it there, also looking a bit flat to the strong side, actually. $1.36 against the sterling at the moment, or against the British pound. And again, all bets are off until the Bank of England decides to make their policy decision, which then could influence this very important currency among the majors later on. We also have the Bank of Japan kicking off a 2-day policy meeting. And of course, this puts the Japanese yen well into focus now. And you can see there it was showing some signs of weakness. Now, again, looking unchanged or flat to the strong side now at just under 147 against the U.S. dollar. And Lin joins us now with a preview of this very important BOJ policy meeting. They saved the best for last, it seems, Lin. But again, what will the Bank of Japan possibly do? What are your thoughts and what are you hearing and seeing that might guide us as to what they might decide on Friday?
Good morning to you, JP. Well, the expectation is that there won't be a move in terms of the short-term policy rate at this decision, but markets will be looking really closely at how the central bank characterises the balance of risks ahead, keeping in mind that there are 2 more meetings to round out the year. So it is really looking at the risks to Japan's economy versus the inflation picture. And although the country has certainly averted the worst in terms of signing that trade deal with the United States, there is still concerns about the flow-through of tariffs to the country. We know, for example, that some estimates still put a 0.5 percentage point shaving off in terms of the GDP in the quarters ahead because of the current tariff regime, and also what the impact that the tariffs as well as potential risks to the U.S. economy could have as well on Japanese corporate profits and how that could flow through to the wages outlook ahead. That is so crucial in terms of the path to a virtuous cycle. And then on the other hand, when we think about inflation, it has been tracking above the Bank of Japan's target for more than 3 years now. But as some economists have been pointing out, is that inflation sustainable when a lot of it comes from the supply side? And then, of course, the other risk that markets are focused on is the political uncertainty with the leadership race in about 2 weeks' time. And although we know that the Bank of Japan has de jure independence, I mean, some are speculating, depending on who wins, whether that could also change the timing ahead as well. JP.
So given all these uncertainties and all these things that are the factors, it seems that nothing is expected to pop from the Bank of Japan in tomorrow's decision. Lin, thank you so much for that preview and helping us understand what we might expect from the BOJ. And we are counting down to the market open in India. This is how we're shaping up, and a final check of how futures or GIFT Nifty futures are pointing. They're still trading significantly above the Wednesday close or the midweek close, about the 200 points now, a day after it reached 25,300, pointing at perhaps a third straight day of gains for the Mumbai benchmark. We're seeing the Indian rupee, as we mentioned a while ago, softening once again to the US dollar. 87.97 is where the local currency stands against the greenback. India's Commerce Minister Piyush Goyal is also in the United Arab Emirates for a 2-day visit. He will co-chair the 13th India-UAE High-Level Task Force on Investments with the head of the Abu Dhabi Investment Authority. A statement from the ministry says Goyal will review progress on the Comprehensive Economic Partnership Agreement and the Double Taxation Treaty. Now, both sides are also expected to explore fresh investment opportunities in sectors such as maritime and space. Meantime, the European Union is also looking to deepen its alliance with India, despite disagreements over New Delhi's close ties with Moscow. Brussels says negotiations on a free trade agreement are now in the final stages, with hopes to seal the deal by year-end. The Commission's new vision paper outlines expanded cooperation with India, spanning defense, technology, trade, supply chains, and green energy. EU Foreign Policy Chief Kaja Kallas admitted there are clear disagreements, but stressed Europe doesn't want to push India further into Russia's arms.
India's participation in Russia's military exercises and its purchase of Russian oil stand in the way of closer ties, because ultimately our partnership is not only about trade but also about defending rules-based international order. Our negotiations will address these challenges and with the aim of adopting a joint roadmap at the EU-India summit in early 2026.
And while the European Union voices concerns over India's ties with Russia, Prime Minister Narendra Modi is preparing to host President Vladimir Putin in New Delhi later this year. The two leaders spoke by phone on Modi's birthday, with the Kremlin saying discussions covered Ukraine and Putin's upcoming visit. And Dheeraj Neem is an economist and forex strategist at ANZ Research. There's a lot to untangle, from trade deals to the Fed's recent decision. And we're glad to have you join us on Inside India to help us make sense of all of this. Dheeraj, thanks for joining us, as we mentioned. Let's start off with the Fed's decision to lower rates, and specifically how this might inform the RBI's own decision. From your experience, how closely does the RBI watch the Fed's own decisions, and how big a factor is this when the RBI is deciding to cut rates, raise rates, or stand pat? What are your thoughts, sir?
Well, with respect to the RBI, it's become very clear in the recent years that the Fed has become less and less of a factor as far as, India is deciding their own monetary policy. And there are understandable reasons why that's the case. India has a very large FX reserves cover that implies some immunity, if not absolute immunity, from the Fed rate changes. In fact, in cycles where the US Fed is cutting interest rates, India has even more freedom to decide their own monetary policy. Now, the yesterday's Fed rate cut, of course, was surprising to some extent in terms of the forecasts that have been laid out in the monetary policy. But the consensus still remains the Fed is going to lower the rates at least 2 more times this year. Now, that gives the RBI more elbow room to conduct monetary policy more independently, at least at a time when the rupee has generally been under the weakening pressure. But I do think that the RBI would still be very, very focused on the domestic growth inflation outlook more than the Fed in deciding the interest rates in India.
So let's talk about that growth inflation dynamic in India, because you can see that growth seems good based on that last quarterly GDP print. Inflation, while it did see an uptick, is still well within the RBI's own target range. The RBI does have scope to cut, which is why I asked that question about the Fed and the RBI's decision. But given the fact that growth is strong and inflation is still low, should they cut? What are your thoughts, Dheeraj?
I think there are certain nuances that need to be considered in both growth and inflation data coming out of India. For example, the Q1 GDP print that came in at 7.8% was, of course, blistering in terms of where the headline GDP growth landed. But it has been pretty disconnected from where the high-frequency data in the economy has been trending. I mean, most high-frequency activity data has weakened in the last few months, and it seems that there is more weakness to come because a lot of the growth risks, for example, from the export slowdown potentially from US tariffs is yet to be fully experienced or fully materialized. In fact, we think that there is a slowdown risk in the second half of the current fiscal year, that is from October to March. So I do think that the RBI would be cognizant of this particular aspect of India's growth dynamic when thinking about monetary policy. So while it can look back at the 7.8 number with great, vindication in the sense that they had been pretty upbeat about India's growth prospects than the market, and the market has recently converged to about 6.5% growth forecast, including us, I do think that a slowdown risk will very much play on their minds. Now, coming to inflation, look, the current inflation is very low it's flirting with the lower end of the monetary policy target range at around 2%. But we have to be mindful that it is because of a certain favorable base effect that is happening in the food CPI index. In fact, if we exclude the vegetable prices from India's CPI, the inflation is already around 4% or slightly below it, and it's been pretty stable. So I do think that while inflation is pretty stable to allow the RBI to possibly undertake more easing, the problem is that the forward-looking inflation could be slightly problematic. So in the last monetary policy meeting, the RBI pegged the Q1 FY27, that is the April to June 2026 inflation, at 4.9%. Now that's prohibitively high. So I do think it could be lower than that, but regardless of that, it would be the future inflation that RBI would be more careful about.
Dinesh, I wanted to pick your brain on something you mentioned, the disconnect between the data and the high-frequency data that you're tracking. And by the way, this is not just happening in India. There have been questions in other countries like Indonesia that have resurfaced as to whether or not there is a disconnect or whether the macro figures are seeing what's happening on the ground. Can you talk to us more about what the disconnect is and, more importantly, why you think there might be that disconnect right now?
Right. Now, in India's case, it's a bit idiosyncratic. The way the GDP is estimated in India and the kind of deflators that we use, it often leads to, quote unquote, overestimation of GDP growth, especially in times where producer price inflation, which we proxy with wholesale price inflation, is very much lower than the consumer price inflation. That is the case at least now. So when you look at the WPI inflation, it's around 0 to 0.5 percentage point year-on-year growth rate. And that contributes to a really small deflator growth in India, which, tends to prop up the real GDP growth, even though the consumer prices that are being faced on the expenditure side at the end level of consumers could be facing much higher inflation. So these are idiosyncratic factors in which which impact the GDP estimation in India. But there was also one more factor that, brought up growth in Q1. I should have actually mentioned it, is the front-loaded public spending. And because the governments are generally tied to their fiscal deficit targets, this momentum will, of course, wane. Now, coming to its disconnect with the ground reality, I would like to say, look at how nominal GDP growth fared. It came in at a bare 8.8%. Look at how corporate earnings fared. From the RBI data, it shows that the operating income growth was just about 5.5%. And bank credit has slowed. Industrial production has not been doing great. Exports are virtually flat. So I do think that there is a bit of a problem in terms of how the high-frequency data are portending growth signals to be, whereas how the GDP data has put the official figures at. So this disconnect in India's case has more to do with methodology than anything else.
Right, so what do we believe in more, Dheeraj, then, if there is this disconnect? What do you think might be more accurate, the high frequency or the macro data that seemed to have caught everyone with a positive surprise when it came out a few weeks ago?
Well, GDP data is backward-looking data. I mean, there's only so much you can drive well by looking in the rear-view mirror. So I would imagine that high-frequency data, at least from here on, would become much more important in gauging growth momentum in the economy. And I think that keeping a good track of how exports are faring, or how passenger vehicle sales, or various other indicators of consumption are faring, would be very important from here on.
So one thing you've also highlighted is that you've noticed that perhaps the consumer demand in India might also be showing signs of slowing down. This is just based off of the research note you indicated. Please feel free to correct me if I'm wrong, Dheeraj. Of course, we do know about the GST reforms that everyone seems to be talking about. Has the outlook on the Indian consumer changed? Or do you think that this is just going to be a one-shot thing that will provide a short-term boost that will then suddenly come down when the longer trends or longer-term challenges resurface once again?
We think that India's consumption spending is actually doing better than it was doing last year. And that has to do with a lot of rural revival that has happened on the back of decent agricultural output and real wage growth in the rural India. which has perhaps supported their consumption after several, quarters of a bit of a slowdown because, the past few years, agricultural growth wasn't very good. So we do think India's consumption growth is doing well. I mean, the latest print put it at about 7% growth, but it has more to do with rural India than urban India. But we have to be mindful that it is urban India that drives the value in consumption, right? The big ticket items, your discretionary consumption and all of it. And that particular segment is perhaps reeling under the burden of high indebtedness because there had been a personal loan boom in India, which has now seems to saturate. And of course, the indebtedness or the cost of servicing that debt has climbed, that could also weigh on consumption. Now, coming to the point about GST cuts and what impact it would have on consumption trajectory, look, I'm not as optimistic as many other participants in the markets are. I do think it's a very strong structural positive that would boost disposable incomes of Indian households. But at the same time, there could be limits to which it can support growth cyclically and for precisely the reasons I mentioned. The indebtedness burden on Indian households has climbed substantially. And at the same time, there is considerable uncertainty with respect to jobs and income, especially in tariff-impacted sectors, where we have seen some kind of layoffs already happen. So in aggregate, I would feel that consumer sentiment may remain limited in terms of improvement. And only few pockets of optimism might be experienced in all of this than a broad-based surge in consumption growth.
All right. Dheeraj, the other thing that could also play on consumer confidence is the weaker rupee, because while that might be good for exports, which again are being threatened by these tariffs, a weaker rupee could also feed into lower consumer confidence. Is there a level where the rupee can get to where it actually starts to show or weigh on consumer confidence in India? And how realistic is it for India to perhaps reach that particular level, if there is one?
I think, in a headline sense, the exchange rate in India impacts people as any other news flow would. But I would imagine, from an economic angle, a weaker rupee does impact the consumer in the sense it brings up the cost of imported goods. It brings up, the cost of other things which are related to trade, for example. But the problem here is that we are facing growth risks which are more demand nature, in the sense that the decline in export demand that can happen because of US tariffs will need to be mitigated. And to that extent, from an economic perspective, we would need a weaker rupee to support exporters' earnings. So that should certainly take precedent. I do not think that a weaker rupee should play dominantly on consumer sentiment, so to speak. At the same time, the kind of cost increases it can bring for imported goods, there could be some offset from the recently announced indirect tax cuts as well. So I think in net terms, it won't really hurt consumer sentiment. Well, when we're thinking of levels at which, the perception becomes particularly bad or adverse, I think that, we all keep holding on to these psychological levels that keep getting broken every now and then. But of course, now people in the market are generally looking at 90 if the current situations persist.
And just quickly, Dheeraj, is 90 your year-end forecast for the rupee, or is it lower or higher than that? Where do you see it by December?
Well, we don't really see at 90, to be honest. I think rupee could very well remain a bit stable around the current levels in the 88, 88.50 range, and that is assuming the status quo. We can obviously see a bit of a rally in the rupee if, some breakthrough happens in India's trade negotiations with the US. But my understanding is that even if the Russia-linked 25% tariffs are dropped, and India's tariff rate stands in 20 to 25% range, it would still mean a meaningful compromise of competitiveness of India's goods. And we would still need all the tools in our toolkit to be deployed to support exporters from those kind of headwinds. And a weaker rupee would, of course, be one of them. And we also have to remember, this is still a central bank that does not like currency volatility very much. So to let the rupee weaken from about 88 to 90 in a quarter's time, I think would be too drastic.
All right.
We have pegged rupee at around 88 at the year end.
Okay, 88 at the year end. That's according to Dheeraj from ANZ Research. Always a pleasure to have you, sir, and thank you for stopping by to help us make sense of how this all shaping where the markets might actually head. Well, Indian markets, as we mentioned, have joined the trading day, but we will look at some movers in Mumbai after a short break. Don't go away. We're back in about 2 minutes. Six minutes since the open out in India, and we are seeing the Nifty 50 now hitting and breaching a new level above 25,400 today, up by about 0.33%. And while it tests that 25,400 level, we have the Indian rupee dangerously close to that 88 level, which was what ANZ's year-end forecast for the local currency is, currently 87.93 against the US dollar. Let's look at some of the movers in the Indian markets today. Bandhan Bank has paired its holding in Yes Bank, selling over 150 million shares to Japan's Sumitomo Mitsui Banking Corporation. The deal cuts Bandhan's stake from 0.7% to just 0.21%. Sumitomo Mitsui, already a major investor with a 20% stake, is set to lift its holding further with another 4% buy from Carlyle. Shares of Bandhan Bank up by about almost 2% so far in the first few minutes of trade. And President Trump is in the United Kingdom for a second state visit, greeted by pomp and pageantry. Jensen Huang and OpenAI Sam Altman are part of a delegation of U.S. executives currently visiting the U.K. and bringing with them billions of dollars in investment. CNBC's Eamon Javers has more.
The royal banquet in Windsor Castle's St. George's Hall took place Wednesday night with a powerhouse group of American CEOs joining the president and the king for the white tie affair, including Larry Fink of BlackRock, Tim Cook of Apple, Jensen Huang of NVIDIA, Steven Schwartzman of Blackstone, Brian Moynihan of Bank of America, and Sam Altman of OpenAI, among a long list of others. Now, they've been hosting state banquets and official dinners in this room since Queen Victoria's reign. It's an impressive venue. The long table runs 164 feet across the whole length of the hall, and we're told that it takes 8 people 3 weeks to clean and polish the service in preparation for an event like this. And what's more, it takes staff 5 full days to lay the table with the dining service. Each guest usually has 6 glasses at their place setting, which came in handy for the drinks portion of the evening. We're told that guests were served 1945 vintage port in recognition of President Trump as the 45th as well as the 47th President of the United States, as well as Hennessy 1912 cognac from the President's mother's birth year. Now, the serious business begins today with a business roundtable event featuring the CEOs, many of whom have announced billions of dollars worth of economic development deals in conjunction with this trip. For CNBC Business News, I'm Eamon Javers in Washington.
And while NVIDIA's Jensen Huang is in the United Kingdom, he has one eye on China, with reports emerging that Beijing has urged its tech firms not to buy NVIDIA's AI chips. Elaine Yu joins us with more details. Elaine, I thought they needed these NVIDIA chips. What's going on exactly here?
Hey, JP. Yeah, so this is the latest in a raft of measures by Beijing against NVIDIA. And according to the FT, Beijing has ordered major tech firms to halt existing orders and testing of an NVIDIA chip, RTX Pro, that's specifically made for China, a downgraded version to comply with the U.S. export restrictions. So this is no longer just about leverage in trade talks, but really about phasing out dependency on foreign suppliers. And Jensen Huang expressed disappointment. He said we probably contributed more to the China market than most countries have. And he said we can only be of service of a market if the country wants us to be. And he acknowledged that geopolitics here is front and center, saying they have larger agendas to work out between China and the U.S. And I am understanding of that. So this really telegraphs or shows Beijing's intensifying push to develop self-reliance when it comes to chips. And this weaning off of NVIDIA reinforces perhaps its belief that necessity is the mother of invention. And it also shows Beijing's confidence that it can catch up. But also today, Huawei claimed that it could deliver world-class computing power using domestic processes. So it's very much reinforcing this message today here, JP.
It seems that more microchips, more problems for Jensen Huang and NVIDIA to deal with, this time coming from China. Elaine Yu, thank you so much for those latest and very important updates in the chip space. And that's all the time we have today on Inside India, but do keep watching CNBC because Access Middle East is up next. Have a good morning.